Since the beginning of 2025, Fiserv is down by 32%, which is a pity for a great compounder like this. So does it represent a great opportunity to start a position? You will see all of this in this video. We have now a price to free cash flow around 15 and a forward price to free cash flow around 12.5. So it might represent a great opportunities for people that want to invest in great compounders at a discounted price. So you will see everything in this video. I think you will be surprised with my view on this company and why for now I'm still not invested, but I might invest soon on it. So compared to the S&P 500, it has been underperforming for the last 5 years with a performance of around 40% compared to 111% for the S&P 500. So in this video, we're going to talk about the business. You will understand everything you need to know about this company. We'll see the numbers, obviously. The moat, does this company have a wide moat, a solid moat or no? We'll see the value, at what price it's interesting to start a position, and also some potential problems that I see for this business. And let's start with some history about this company. It was founded in 1984 by the combination of two regional IT service providers, First Data Processing and Sunrise System. In 1991, Citicorp Information Resources got acquired by them, expanding its core processing capabilities. And this acquisition put Fiserv into the commercial banking, internal and credit union core account processing market space. This was one of Fiserv's largest early acquisitions that significantly expanded its market presence. In 2007, they acquired CheckFree, and to provide financial electronic commerce service. This major acquisition strengthened Fiserv's position in electronic bill payment and online banking service, making a significant expansion into digital finance service. In 2019, which is a very recent one and potentially one of the most important lately, they did the acquisition of First Data. It was an acquisition for around $22 billion. And thanks to this merger, it created a payment and fintech powerhouse, dramatically expanding Fiserv merchant acquiring and payment processing capability. And in 2023, they changed their name, ticker, and so on. They changed the listing from NASDAQ to New York Stock Exchange, and now the new symbol is FI. So how do they earn money? First, it's a leading provider of core processing and complementary services such as electronic fund transfer, payment processing, loan processing for US bank and credit union with a focus on small and mid-sized banks. Through the merger with First Data in 2019, Fiserv also provides payment processing service for merchants. About 10% of the company revenue is generated internationally, so it's very concentrated. Here you can see the different area where they make money. So the merchant solution is 47%, financial 46%, and then you have others, which are 6.6% approximately. So let's start by talking about the merchant solution, which is the biggest segment for Fiserv. You have a part in small business, So the main product here is Clover. This is a flagship cloud-based point of sale and business management platform. Revenue is generated from payment volume processed through the platform, the sale of Clover hardware device, and software as a service, SaaS capabilities, and value-added service. So basically, you are a little business, a restaurant, a cafe, whatever. You need something to make people pay and to manage everything, inventory, manage kind of everything in your accountability, tax, and so on. You pay the hardware, and from the hardware, every time you have a transaction, they will take a small fee. Every time they will add you also some service that you might need. So for example, some tax products, something to make your efficiency better, some AI, everything that could be added into the hardware, they will charge you some recurring fee and some small fee for each transaction. So it's actually a good business. You also have Clover Capital. This program generates revenue by providing cash advances to small business owners, and payment acceptance. These enable small business to accept credit, debit, gift card, and loyalty payment online, in person, or via mobile devices. You also have the enterprise part, which is big corporation. Here, the product name is Karat. It's basically kind of the same than Clover, but adapted for big enterprise. Before, they didn't have the difference. Now they made the difference because it's better. Small business and big enterprise, they don't have the same type of needs, okay, when it comes to all of this. So this is an integrated omni-channel operating system for enterprise clients. It generates revenue by providing a suite of services through a single platform, helping clients to maximize payment approval rates and reduce declines, lower fraud and chargebacks, access solution for payment acceptance, payment optimization, fraud mitigation, and digital payout. It enables modern consumer experience like buy online, pick up in store, or order ahead. They have also store value solutions. Fiserv earn revenue by implementing and managing gift card and loyalty program for large businesses, including both physical and digital card fulfillment, program management, and transaction processing. And the biller solutions, the company provides electronic billing and payment services to companies such as utilities, telephone and cable companies, and insurance providers. You have the third part, which is processing in the merchant solution. This line generates revenue by providing product and services to financial institutions, joint venture, and other third-party resellers like ESOS who have direct merchant relationships. These partners use Fiserv's technology and processing capabilities, which are combined with their own distribution channels. So here you can see that the small business is the most important part here because it represents most of the revenue. Okay, for a total adjusted revenue of 2.6 billion, 1.7 billion is from small businesses. So it's really the most important part. It's growing 10% per year approximately. It was growing a bit more before. And that's the reason why the stock declined so much. It's because they have less growth than it was expected and they thought it will go way faster. But you still have some growth, a total growth of 9% year to date. The financial solution now. First, you have digital payments. Okay, this line focuses on enabling digital payment capabilities for financial institutions. So you have debit card and network services. Revenue is generated from debit card processing, including tokenization and loyalty programs. Fiserv also own and operate the global thing. You have a product named Accel, Stars, or MoneyPass, a network, earning fees from transaction routed through them. Okay, so it's a bit like Visa. When you pay with your Visa, you pay a Visa, get a transaction fee. But that's not the only transaction fee that you have. You have also a transaction fee from the bank, okay, where your Visa need to connect to a bank or MasterCard or American Express, whatever card, it need to connect to a bank. And this allowing to connect to the bank, it's a service provided by Fiserv. You have also the P2P payment. Fiserv offers a turnkey implementation of Zaye P2P service, generating revenue from this transaction. You have the bill payment. Revenue come from the CheckFree RXP electronic bill payment and presentment product for financial institution, and also some ACH and real-time payment infrastructure for financial institution to process ACH, wire, and instant payment, including connection to the FedNow service and RTP network. The second one is issuing. Okay, this line generates revenue from service related to the issuance of payment cards and other financial documents. So credit card processing, okay, they provide transaction processing for credit card issuer using platforms like Optis, First Vision, and Vision Plus. Revenue is driven by the number of active accounts. Card and statement production, the revenue is generated from physical card manufacturing, personalization, and mailing of payment card and business statement. So they build the card. Okay, when you need a Visa or MasterCard, when you ask your bank to get one you want, they will contact Fiserv to create the card and then send it to you. You have also prepaid and government service. The Money Network, for example, service provides electronic payroll and government disbursement solutions, earning revenue from this program. Fiserv also processes payment for state entitlement, unemployment, and disability programs. The third one in the financial solution is banking. This line provides the foundational technology for financial institutions to manage customer accounts. So core account processing, this is a major revenue source enabling banks and credit unions to process customer deposit and loan account. Fiserv offers several core platforms, including ClearTouch, DNA, ThinkSat, Portico, Precision, Premier, and Signature. a digital banking platform. Okay, revenue is generated from the Experience digital platform, which enable online and mobile banking, fund transfers, and personal finance management tool for customer or financial institution. And then financial and risk management. The company earned revenue from solution for financial accounting, reconciliation, and fraud detection. So who are the clients? I think it's pretty obvious with what we saw now. So you have some small and mid-sized business that will use Clover Capital, payment acceptance, and so on. Some large businesses, enterprise, which would use Karat, store value solution, biller solution. You have banks, credit union that will do core account processing, digital banking, debit and credit card processing, network service, digital payments, enterprise payment solutions, financial and risk management. The public sector, payment distribution, output solution, and financial process management. So you have a very wide zone for client for Fiserv. The sales by country, we saw it already, 85% in the USA, 15% outside internationally. The market. So the overall market is expected to grow between 8 and 10% for the next 5 to 10 years. Each branch of Fiserv is expected to grow differently. Okay, the financial area mostly 6 to 8%, while the merchant area more between 8 and 12, 15%. So overall, we have something around 8 and 10% growth for the next 5 to 10 years in cumulative annual growth rate. For the competition, same, we'll divide between merchant and finance because it's kind of two different business a little. So the merchant, Fiserv have 12 to 14% market shares, which is good. They are not the first one here, but they have a dominant position. As competitor, you have Block with Square. Okay, they are dominant in small business with POS. You have Adyen, which is new competition, which is for now mostly in Europe. The advantage here is I think it's more difficult for European company to get into the US market and easier for US company to get into European market. So Adyen is a serious competitor, but I'm not sure they can be a very big threat over the long run. You have PayPal, which is mostly online, Stripe, which is also popular for startups. And if you have businesses, e-commerce and so on, a lot of people use Stripe. You have Chase Payment Solution, which is a leader in the market with 17% approximately of it, is mostly for enterprise. And you have also Global Payments, which have 11% of the market. In the banking area, they have 35 to 38% of the market, so they are leading this. As a competitor, they have Fidelity National Information Service with 20-25% of the market, which have very similar products than Fiserv, and Jack Henry and Associate with 20-22%. It's mostly for regional bank, okay, small regional bank. They are well positioned in this. And you have Temenos, which is mostly European, and Oracle Financials, which is this one mostly for large banks. Okay, they are more focused on this. The team, you have Mike Lyons, which is CEO since 2025, and it was former president at PNC for a year, but he has been working there like since longer than a year. And you have Robert Howe, which is CFO since 2016 in Fiserv. In the owner, nothing particular to say. It's mostly institutional. So there is nothing interesting here. So now let's get to the number. Let's see what number we have with Fiserv. So we have an overall score of 58. The reason for this score is because most of the data are calculated, like, let's say return on capital employed is calculated with net income, and it's a company that have cash generation, cash conversion higher than 100%. So if we calculate all of this with free cash flow instead of net income, it will put the grade slightly higher, but we have some interesting things. We can see that the growth for the total revenue has been for the last 10 years at 17% per year. The reason is they did this acquisition in 2019. So if we take out this acquisition, and let's go from 2020 now, it's growing by 8% per year. It's a company going by 8% per year and expected to grow by 5 to 6% per year their revenue. When we look a bit more down, we look now at the operating income. So same, we had this acceleration after this, but this is growing by 33% per year. So after doing the acquisition, they really put it well with the business and they improved operation system. They improved every operation thing for the company. So it's like thanks to this that you can have a growth of the operating income way higher than revenue, which means that the margins are getting better. If we look at operating margin, they're getting better over time since the acquisition has been made. We have an operating margin around 30%, which went from 12% to 30. And before the acquisition, we were around 30%. So they do the acquisition, they try to operate well and integrate it well with all the systems that they have, and then it go well. So it's not the first time that they do this. Every time they do an acquisition, it's a bit like this. But we can see that we have a solid trend for operating margin and a company that is very good to operate a business and to operate the acquisition that they are doing. When we look at the number of shares outstanding, they are decreasing. They got higher with the acquisition, but every time after, they buy back the shares. Okay, we have buybacks going by 5% per year, 4.5% per year. Okay, since acquisition is done, since 2020, 4% per year of buybacks, which is really good. Okay, which is something good. We'll see after that. We might have something not pleasant with this. For example, when we look at the P ratio, for example, when the buybacks are done, we could say that they could potentially do something better. Where it is financing, stock repurchase. You can see here the stock repurchase. So they do more now with a low PE, but we could argue that maybe here in 2024, where the PE was high, they could have done potentially less acquisition, less buybacks, and focus more to do some this year, to do way more. But it's still good. We like having a company that regularly do buybacks and that the buybacks is inside. When we see the evolution of the EPS, it's same. We have 39% per year, so really, really good. Over the last 10 years, 12%, because here it got declined since the acquisition and then got back, so they need time every time they do an acquisition to bounce back, but we have something very good with the growth rate, okay? Over the long run, 12% per year EPS growth rate. That's why the stock is performing well over the long run. You can see the free cash flow, same, 19% per year over the last 10 years. So it's a company which is good. The problem that we may have is the debt. Net debt to EBITDA is 3.36. The interest coverage is at 980, so it's good, but this debt to EBITDA, it's something that I'm not a big fan. I'm not a big fan. I understand that it's because of the acquisition and they really decrease it, but here it's going up again. They went under 3 and it's going back up again. So it means that if we have a financial downturn, if we have an economic downturn, it might be problematic to have that much debt to pay. And they might be pressured by the interest that they have to pay on this debt, okay? Because you see that it went down. Now the interest coverage is really good, okay? It went back very good and they generally have something good with this, but it could be like they could take more care of this debt compared to EBITDA. I hope they will increase it and make it better, use cash to buy some more debt, to buy back the debt, to like reduce this, but it can be problematic, especially when we look at the evolution of the debt. Okay, we look at the total debt. You had a spike since acquisition, and now they continue to increase the debt. This I'm not a big fan. I'm not a big fan of them continuing to increase this debt, especially that now interests are not very low. Okay, if interest were close to 0%, why not? Like in 2019, why not? But now they continue to increase this debt. And because of this, you have the cost of capital, which is higher than basically the capital efficiency, that return on capital invested or return on capital employed. Let's take the ROCE. It went down because of the acquisition, and now it's going up calmly, but we're not back to what we were before. It might need a bit of time to go back up, okay? It's not the first time when they do an acquisition that it goes down, okay? It went down here as well after an acquisition, it went down. Here it really dropped a lot, but it's normal. I don't know if they will manage to get back over 15%. This is a bit problematic for me considering the debt level. Now, if we compare this company with competitors like Adyen, GPN, and Global Payment, and what is the other one? XYZ is Square. Okay, we look at the revenue. If we let's take for the last 5 years to not take into account the acquisition, we can see that Fiserv is growing at a good pace, okay, a bit less fast than XYZ and a bit faster than GPN. You have Adyen, which is going way faster, but Adyen is new, okay, it's new enter in the market. They have 10 years, a bit more, 12 years, so it's normal that they grow a bit faster. When we look now at, let's have a look, the operating margins, we have Adyen, which is top notch, okay, 50%, and under you have just Fiserv. Fiserv is under. Under you have as well global payments, and to finish Square. 5% operating margin for Square. I'm not a big fan. I don't like it. Fiserv is well positioned. We could say that it's not possible for Adyen to keep those margins. I don't know, to be honest. They had a huge increase in 2019. We will see how they go. But Fiserv have a good position if we go over the long run. Fiserv has always been a good position for operating margin. It shows that they're really good when it comes to operate the business and so on. Now, if we look at the EPS, the evolution of the EPS between all those companies to do a comparison, you can see that Adyen is starting to get very, very strong in this, okay, with 24% cumulative annual growth rate, but yet we have Fiserv, which is growing faster. And at the end of the day, price follow earnings, okay, price follow EPS, and we have a very solid growth here. Square is growing as well very fast because Square was not profitable. It's profitable only since, it has a non-profitable year in 2022. If we go over 10 years, okay, you have Fiserv at 12%, the other one higher, okay, but it's because it got a few years down because of this acquisition. So that's why I think 5 years is more relevant. Well, let's compare now the way it evolved with some ratio. So let's have a look at the net debt to EBITDA. You can see that the higher one are for Fiserv and global payment, okay. Adyen is negative, very good, and same for Square, negative, so this is good. And for the return on capital employed, here we have again Adyen, which is on the top here, and second one we have Fiserv, which is over both of GNP and XYZ. So they are in good position. You have Adyen, which could be a problem, okay, which is an instant competitor. We need to see how Adyen will integrate in the US. For the other part of the business, we have also Fis and Jack Henry. We can see here for the total revenue over the last 10 years that Fiserv is growing way more than the other. So this is good, but it's because they have these two segments. So that's what's helping. Operating margin, same. You have Fiserv that have better. Okay, they have better than the two other. But same again, there is a merchant solution that help, but it just shows that they are well positioned. Okay, Fiserv is well positioned. You have something very interesting to see with this company with a number. By the way, the website I'm using is the one I built. It's Margin. You can have a look at the link in the description to have more information. Let's continue with the SWOT analysis of the company. First, in strength, you have a market leadership with diversified business, okay, leading global provider in payment and financial technology, serving a wide range of clients from merchant to financial institution, which provide revenue stability. High quality recurring revenue, okay, 81% of 2024 revenue come from processing and service, primarily from sticky multi-year contract with high renewal rates, ensuring predictable cash flow. So this is very good. Strong financials and shareholder returns. The company has a strong growth outlook, 15 to 17% adjusted EPS growth guided for 2025, and aggressively returned capital to shareholder by buybacks. $6.9 billion of buybacks have been done in the last 12 months. They have also key proprietary technology platforms, own high-growth cloud-based platforms like Clover for small business and Carrot for large enterprises, which are central in its growth strategy. Extensive distribution network, leverage a multi-channel sales approach, including direct sales, strategic partnership with ISV, and alliances with financial institutions to achieve broad market penetration. When it comes to weaknesses, A significant debt load, okay, that's a big weakness in my opinion, carries substantial debt, okay, approximately 25 billion, which could limit financial flexibility and increase interest expense. Dependent on third-party relationships, a portion of business relies on merchant islands and partnerships that Fiserv does not control. The non-renewal of the Wells Fargo joint venture highlights this risk. High goodwill and intangible asset. Goodwill and intangible makes up a large portion of the balance sheet, 60% of assets, creating a risk of significant write-down if business performance declines. Operational and system reliability risk. The business is critically dependent on the reliability of its technology. Any system failure, security breach, or software defect could significantly harm its reputation and financial results. And of course, exposure to volatile economies. Okay, if nobody starts buying things or anything like this, obviously it will decline. Or you can have some inflationary economy, particularly like Argentina, that have resulted in significant foreign currency exchange loss, 98 million in 2024 and $164 million in 2023. And of course, the low return on capital that I think it's problematic, less than 15% ROCE and ROIC, and also it's the weighted average cost of capital is higher than the return on capital, so it's not really good. When it comes to opportunities, you have growth in digital commerce. Okay, the ongoing global shift to digital payment, e-commerce, and real-time payment provide a powerful tailwind for Fiserv's core services. International expansion. Fiserv is actively acquiring companies abroad to grow its international presence, which accounted for 15% of revenue in 2024, and to expand the global reach of its platform like Clover. You have an increased penetration of value-added service. There is a significant opportunity to sell additional service like analytics, loyalty program, and capital access to its large existing merchant and financial institution client base. The leveraging of the ISV channel, the company identifies thousands of potential partnership opportunities with independent software vendors, so to integrate payments and cross-sell services. Strategic acquisition. The company has proven strategy of acquiring businesses to gain new technology like fintech for digital banking, enter new market, or achieve a greater scale. In other opportunities, now they are preparing some processing payment, and they want to create their own stablecoin. Okay, to process all of this. It can be an opportunity. I didn't put it because I think now it's not a big deal, it's not a big opportunity, but they're working on this. So if some of you are crypto bros, that's potentially a good news for you. When it comes to threats, in intense and evolving competition, okay, they face intense competition from a wide range of players, including other large processors, financial institutions, in-house systems, and disruptive fintech companies. The cybersecurity risk, okay, they process a large volume of payment and everything is digital, so there is always this cybersecurity risk. The complex regulatory landscape, okay, in all the banking area, GDPR and so on, it's difficult to manage all of this. Also some rapid technology changes. The market is characterized by constant technological innovation. And Fiserv must continuously invest heavily in areas like AI to avoid being outpaced by more agile competitors. My theory here is they don't focus really much on this. They focus to have a lot of cash to be able to acquire companies that could disrupt them. I really believe it's what they do strategically. So that's maybe they will not innovate that much. Just stay around and acquire companies that seem to be very innovative. You have also the macroeconomic headwind. Okay, it's exposed to economic downturn, rising interest rate, inflation, political instability, which can reduce consumer and business spending and lower transaction volumes. Now, when it comes to products, are the products essential? Yes, merchant and financial products offered by Fiserv are needed. Okay, we need them to process and so on. So yes. Are the sales predictable? Is there any regularity? Yes. Most of the revenue are recurring, sticky, and with high retention rate. Is it a wide market with tons of clients? Yes, again. Is it difficult for clients to change to competitor? Yes, especially when they install everything from Fiserv, and when they have the hardware, it's very difficult to change because you will change the hardware to get to another brand while everybody know how to use this one. So this can be very sticky. So yes, difficult to change. Are the product resilient to changes and innovation? Yes and no. Okay, it depends which products. They need to generally adapt. They're doing it well, but some yes, some no. The position. Are they market leader? Yes, in most areas of operations, they are market leader or close to be market leader. Is the market open or closed? Can competitor enter easily? It's pretty open. Competition can enter easily. Again, it depends of which segment of the business. For some transaction things in banking area, it's not really open, but in some other business, it can be open. Are they price maker? Yes, due to high retention rate and due to the fact that they have hardware. But again, they have different part of the business which could literally be a different company. So they are price maker on some part, less on some others. Is it easy to forecast the growth? Kinda yes. It's very kinda predictable. They don't really disappoint, and it kinda go correctly. Are they dependent on geopolitics? Not really. I mean, not more than other companies. Is it easy to find new clients? Yes and no. Because of the increase of competition, finding new clients it's more and more difficult. The management. Does the growth come from outside or inside? It's historically come from outside, so it means acquisition. They mostly acquire the company to be able to grow. Is it easy to manage a company? To be honest, no. There is some high capex. They are doing some acquisition. It's a competitive landscape, so I will not say it's easy to manage this kind of company. Is the company focusing on creating good products? Yes. They have a client-first policy. You can listen to some interview of the new CEO, and they're really focused on the client. Are the important team member good? Yes. For now, they seem nice, fine, or good. I listened to some interview from the CEO, and he seemed very competent. He seemed to be a good fit for the company. Let's now talk about the Moat. The Morningstar rating is narrow moat with stable trend. And if you read the note from Morningstar, they say that a big part of the business is a wide moat, but some parts, they seem to have a very little moat or no moat at all. So that's why they put narrow moat for the company, for Fiserv. The return on capital employed, return on capital, invested capital is under 15%. Even before acquisition in 2019, it was slightly over 15%. So this could be problematic, especially that now it's lower than weighted average cost of capital. That I don't really like this. The margins, they're increasing over time. They show that they're good to operate business and to improve the margin. So this is something good. Does they have a switching cost moat? For me, it's high. Okay, they have a high switching cost, especially with the software, with the partnerships that they're doing. So yeah. Do they have a high pricing power? For me, it's medium. When it comes to intangible assets, for me, it's high as well. Efficient scale, not really. And cost advantage, not really. They might have on some point, but not really. The main moat for them, I think it's switching cost, intangible asset, and network effect, medium. Okay, on some things they might have, on other, way less. So really switching cost and intangible asset, I think it's the two main advantage of the moat for Fiserv. So question and problems that I would like to point. I already pointed it, but the low return on capital compared to WACC doesn't seem to improve since the last acquisition. Okay, will they be able to face the competition and get some growth coming from something else than margin expansion? Because that's also something that the revenue doesn't go that fast. It's mostly because they make higher margins, and you have really big growth coming from hiring the margins. So we need to see a bit more of sales growth. And here you can have a shot from Guru Focus showing that the difference between the return on capital, invested capital, and the weighted cost on capital. They also have some high level of debt, which can be problematic. So now the company is priced around $140 per share. The 10 years average price to free cash flow is 22. Actual price to free cash flow 13. Forward price to free cash flow 12.5. Growth rate for revenue around 5%, and for EPS 16%. So if we go to my DCF calculator. If we take an assumption that the free cash flow will grow by 10% per year, they will decrease the number of shares outstanding by 2% per year, and we have a price to free cash flow of 18. The fair value should be $160, and at this price at 140, we could do 16% per year, which in my opinion seems to be kind of fine. We can look at some ratio here. We see the evolution of price to free cash flow. And now it's a company that we pay 13 of a free cash flow, which is very low. The last time it was that low, it was in from 2008 to 2011. Remember what happened during this time? Pretty normal. So it's not really usual. The median is at 20 for the last 20 years, and for the last 30 years, the median is same at 20. So I think by putting it at 18 is pretty good. When we look at the growth profile, EPS expected to grow by 28%. I think 15% is already good. I don't take any risk. I put 10%. I think 10% is really achievable for this company. For the free cash flow, they show that they are able to do it. If we look at the evolution of the free cash flow, over the last 10 years, it grew by 20% per year. For the last 5 years since acquisition, 20% as well. For the last 20 years, 14%. So I really think that they know how to grow a free cash flow, 10% per year. I think it's reasonable. We can potentially put higher. So in my opinion, if you like the company, now it's a fair value. Okay, it's, in my opinion, undervalued, and it could represent a great opportunity, again, if you like the business. So as score, I'm putting as a quality score around 70% and value score 85%. In my opinion, the company is undervalued if you like the business. To conclude, they have a great track record of performance and acquisition. Debt level are too high. It's a bit risky if an economic downturn arrives soon. If you don't think that any economic downturn will arrive in the next 3-5 years, we probably don't really care about the debt. But if we have one, even a little one, it can be problematic for the company. They have wide moat on some business segment. It's on my watch list now and start to be really undervalued, but I'm not a big fan of the low return on capital. So I'm still studying the business to take a decision if I want to add it in my portfolio or no. If you have any other information that I didn't share in this video, from your analysis, from your research and so on, please leave it in the comment section. I will be very happy to read about it. And also people watching this video that want to learn about this company, if you have information, put it in the comment. It will be very nice to read about it, debate about all of this, and grow all together. So that's all for this video. If you liked it, remember to put a thumb up and subscribe to the channel to see other analysis and video. I will see you in another video. Bye.